And the students that are in the class that have already submitted your questions, I will answer your questions first. So I'm looking here and I'm scrolling through, and I want you guys to know, those who are in the options masterclass and or the options program in general, just know that I'm going to create a new link to a private blog where you can ask me questions so I can make sure your questions get answered. I see a question from All Things Business. Boyce, what is a good implied volatility number, open interest, and volume number to look at when deciding to write a call? That's a very good question. You know, when I look for numbers, I don't look for a specific implied volatility number when I'm deciding which options I want to write calls on. I kind of look at a whole list of things. And if you go back into the material that we covered during the options masterclass, you can sort of see the thought process. Really what you're looking for is you're looking for stocks that are that have good liquidity, that meaning that they're being traded pretty regularly. You don't want to try to dig into a market where the trading is overly thin, or where the trading is, or the companies are too small, or you're just going into a bad market. It's kind of like trying to go and you know, buy a car in a bad neighborhood. You don't want to be in a bad neighborhood. You want to try to get to a good neighborhood. So what I would say is that, you know, if you sort of follow the guidelines that I laid out when we were going through it in class, you'll see that basically I like companies that are maybe $1 billion in market cap or higher, medium to high volume. I also, you also really want to be careful about the history of the company that you choose to dig into. If you dig into, say, for example, these pharmaceutical companies, those suckers will take you for a roller coaster ride, unlike anything you've ever seen. So I encourage you to just be thoughtful about that, because those companies can really sort of eat your lunch if you're not careful. I've seen some pretty bad price drops, you know, on some of the pharmaceuticals, but they tend to have the highest implied volatility, which makes their options most attractive. But you got to realize that usually you get what you pay for. So usually if there's a high reward, you got to go look for the risk. Don't just assume that it's free money. There's no such thing as a free lunch. That's really what's true in investing. Usually if there's more return, there's going to be higher risk, and you got to sort of figure out where that risk is located. Let me see, next question here. Let's see. Okay. What's better for a newbie, individual stocks or options? I think individual stocks or even mutual funds, because I think that if you're a newbie, you don't want to dive into options. I know a lot of newbies dive into options, but what happens is that the options market, because there's so much action there and there's so much money that's made pretty quickly, you know, it becomes like a casino. And I'm not going to tell you what to do. I'm just going to say that, you know, that trading is not the same as investing. So this sort of get in, get out, get rich quick, make your money fast, that's not really investing culture in terms of planting seeds and growing money long term. That's you know, quick hustle, quick money culture. And I think that's fine. I'm not judging that. I'm just saying you got to know that when you do that, you're not really investing. And I think it's very important for you to kind of know the difference. Let me see here. Explain annuities. Annuities are basically a consistent payment over and over and over again over a long period of time, but they don't have to be a long period of time. An annuity technically could be, you know, 2 payments, right? Or 2 days worth of payments or something. But it's basically when you get money paid, you know, the same amount over and over and over again for a certain amount of time. A perpetuity is when you get paid the same amount over and over again forever. So perpetuities and annuities can be valued. There are valuation formulas that allow you to value annuities and perpetuities. Stocks get valued as perpetuities. The thing is, though, the reason you see the stock prices and valuations going up and down so much is because even though the models are very precise, the information that's put in the models is not precise, because you're estimating what the cash flows are going to be for that company over a long period of time. And nobody really knows what that's going to be. You can only guess at that. You don't know how much money Exxon's going to make 14 years from now, but that's in the equation. So, you know, annuities and perpetuities are important to understand when it comes to investing, because one thing that people seem to forget is that when you buy a share of stock, you're buying ownership of a perpetuity. You're buying ownership of cash flows. And so as information comes in that changes the value of those cash flows, that changes the value of your stock. That's why most of the time when stock prices move heavily, there's usually some news or information that causes that shift. It's not just, you're not just buying a bunch of lottery tickets. So don't think of stocks as a bunch of lottery tickets. They actually have a meaningful, relevant, fundamental value that's attached to cash flows that are going into the company. Let's see here. So ST751 says that there's a video missing in the let's see, in the masterclass. Yeah, I think for one of them, I did not hit the record button, and I am so sorry for that. I totally screwed up. But I did some extra lectures for you guys to make sure that we really over-covered and over-delivered. And because in the Black Business School, our goal is to over-deliver for you. If you have any questions or any issues, or you feel like you didn't get something you were looking for, just email support@theblackbusinessschool.com. That's support@theblackbusinessschool.com, and they'll take good care of you. They will make sure, their mandate is to make you happy, is to do whatever they can to make you happy. And if that doesn't work, then they give refunds if necessary. But we'd rather make you happy, right? We want you to invest in us, so we want to make sure we invest in you. Let's see here. You're from Albany, New York. Your alma mater, Syracuse University. Do you support investing primarily in index funds? I think you can make money that way, but I don't think that that's the only way to invest. I like index funds, but they're not as much fun. They're funds, but they're not fun. They're unfun funds. How about that? Pun intended. What's a cheap stock to acquire? 100 shares, then write call options on it. You know what? When we went through in the master class, we laid out a step-by-step process where I showed you guys how to identify stocks that you may want to write call options on. You're basically looking for stuff with high implied volatility with a low enough price that you can get 100 shares. 100 shares is the minimum that you have to have in order to participate in the options market, either as a buyer or a seller. And so we showed in class that basically writing call options can generate substantial income off of a stock portfolio that's actually better than what you might get from, say, having rental property or something like that. Because, I mean, and it really reflects basically the fundamental ideology behind what investing does. Investing means that you acquire a bunch of assets and you make money from those assets, right? You just, like if you have a bunch of land and you're a farmer and you farm tomatoes on the land, then that's you have your capital. Your capital is your land. That's why Black people losing their land was such a big deal, because we lost our capital base. So when you don't have a capital base, you have to go basically farm somebody else's land. So you become a sharecropper. So because Black people don't really have a capital base in America, we become sharecroppers. We get these college degrees and we go and we take care of someone else's business. So basically you're farming somebody else's land because you don't have land. When really, ideally, you should be farming land that you actually own, so that you get the capital gains on that land, as well as a substantial percentage of the income generated from that land. So if you want to actually, if you go to, I think it's blackoptionsinvesting.com. That's blackoptionsinvesting.com. You can actually try out the options investing program for just $1. So feel free to go to blackoptionsinvesting.com, and I'm going to lay out that framework. Also, I'm going to do a black stock options weekend, the same way we had the black stock market weekend before. I'm going to do a black stock options weekend, and it's going to be free for everybody who's in the black options program, or black. So it's blackoptionsinvesting.com. So feel free to go to blackoptionsinvesting.com. Let's see here. Next question. I know that you're not a fan of technical analysis when trading stock options, but will the fundamental analysis that you teach us allow us to have knowledge and or capability to gauge how to minimize risk when we enter exit trades? Yeah, you can minimize and max. You can minimize your risk. Sometimes you don't want to minimize your risk. Sometimes you want a little bit of risk because you want a little bit of return. The universal relationship in financial markets in general is that there's supposed to be a positive relationship between the amount of risk that you take on and the amount of reward that you receive. And so ultimately, a lot of times, we think that risk is a bad thing. It's like talking about debt. You might hear Dave Ramsey and other people, they seem to imply that debt is always bad. That's just not true. Debt, and it's fine. I'm not judging, but I'll say, a lot of the folks that teach, stock market investing and stuff like that, I guess they understand it differently. But when you have a PhD, you really can see the playing field in so many ways that that's just even hard to describe. And so one of the things I'll say is that debt is not bad. Debt is not good. Debt is just powerful. That's all it is. Debt is powerful. It's like fire. Is fire good or bad? No, it depends. Is a gun good or bad? Well, it depends. What do you need the gun for, right? And so basically risk is something that some people actually want. You know, that's why the options market exists. There are people that buy options because they want to take on that risk, and somebody sells the option because they want to sell the risk. So I tend to be a person that doesn't like a lot of risk. If I don't want risk if I don't have to take it. So I'm not out here trying to get rich. I'm trying to protect what I have, right, and then grow that consistently without killing my asset base. So so I'm more likely, because of my risk preference, that's what they have terms for this: risk preference, risk tolerance. Because of my risk preference, I'm more likely to sell an option and say, hey, you want to speculate? Fine. You know what? Just give me some money. And if my stock goes above a certain price, you can have all that upside. That's totally yours. I don't care. Just make sure give me my bird in the hand. I'll let you gamble to see if you can go get 10 birds in the bush. So ultimately, understanding financial tools and understanding how to basically create insurance and really protect your trades is a way of just kind of, sort of thinking about all the scenarios. It's a matter of being economically strategic. Economic strategy, to me, effectively means playing out all the scenarios, thinking about all the things that can go right and all the things that can go wrong. You don't want to be over biased in one direction or the other. For example, part of the reason Black people are not as likely to become investors or business owners is because we tend to have the habit of seeing all the things that can go wrong without thinking about all the things that can go right. So when you think that way, you don't take chances, right? But then there's the other side. When you think about all the things that can go right and you never think about all the things that can go wrong, then you make other mistakes. Like you don't protect yourself. You don't protect yourself from the downside because you think that there's only upside. Well, you don't want to be out of balance. And if you are out of balance, you want to be aware that you're out of balance. So one of the things that in terms of how I teach, that probably maybe I don't know if it frustrates people or enlightens people, but I rarely give a yes or no answer when it comes to a type of investment. So for example, somebody says, should I buy options or should I invest in the stock? The answer is almost never yes or no. It's a matter of, do you know what it is? Even when we talked about these blessing looms, which are technically legally defined as pyramid schemes, people were saying, is that bad or good? And I said, well, it is illegal. But as long as you know what it is, then and you make a decision based on, like you make a fully informed decision, then who am I to tell you that it's not a good decision to make? If you know what it is. The problem with the blessing loom, where you have to go recruit 2 people and all that. The problem with that is a lot of people go into it and they don't know what it is. They think it's guaranteed money, and there's no such thing as guaranteed money when you're putting in $200 and you're going to get back $1,600. There's no way that can be guaranteed. No way. No way. No way. No way. No way. Did I say no way? Okay, good. All right. So I'm going to put this recording in the inside Ask Dr. Boyce, and you can log in if you just go log in at blackoptionsinvesting.com in the options program, or you might be in the Black Stock Market program. You can go into Ask Dr. Boyce, which comes free with both of those programs, and you can actually get access to this recording as well as any others. I tend to record the Q&As when I'm answering questions because even if I answered the question 2 years ago, it can benefit you. So take care, guys, and I'll talk to you soon.